You've owed back taxes for years. You've wanted to do something about it for a long time. In the midst of the COVID-19 pandemic and the economic fallout that came with it, you're wondering whether the IRS is more open to settling your tax debt. Is this actually a good time to negotiate with the IRS? That's the topic of today's video, the second in a two-part series, on the other side of the break.
1-877 Levy King, Levy Levy King, 1-877 Levy King, LevyKing.com.
What's up, guys? Corey Hankerson here from Legacy Tax, and they call me the Levy King because I've helped thousands of clients with unfiled returns, back taxes, tax liens, and that's right, IRS levies. If the IRS took your check, the Levy King will get it back. 1-877 Levy King, LevyKing.com. I'm also the author of End the Tax Nightmare: Insider Secrets to Beat the IRS and Reduce Your Tax Debt. Inside the book, I'll show you how to stop IRS levies, liens, and garnishments without paying the tax in full, how to set up the payment plan you want, not the one that they want, and how to potentially settle your tax debt for less than you actually owe. My book has been a top seller on Amazon for years. You can buy it right now for $19.99, but I want to give you a copy of the book absolutely free. Just go over to my website, www.endthetaxnightmare.com, pop in your name, your email, and I'll send you a copy right away. No charge, not even for shipping, totally free. Now, before we go any further with today's video, I want to take a moment to ask you to please subscribe to our channel and also to like us on Facebook and follow us on Instagram. All right, guys, let's dive into today's content. As I mentioned in the first video of this two-part series, people have been asking whether the IRS will accept more offer and compromise applications because of COVID, or will more people qualify for an offer because of the pandemic? Now, as I said in part one, the answer seems to be that COVID may affect the OIC process as it relates to offers based on doubt as to collectability, as well as offers based on effective tax administration. In the first video, I discussed the OIC based on doubt as to collectability. In this video, I'm going to discuss how the pandemic and the economic fallout might make it more likely that your offer based on effective tax administration gets accepted. All right. So before I do that, what is an offer in compromise based on effective tax administration? The offer based on effective tax administration, or ETA offer as I call it, is by far the least popular OIC type. In fact, over the course of my career, I've rarely come across one. If you don't qualify for an offer based on collectability, usually because your reasonable collection potential is more than the debt that you're trying to compromise, you might still qualify for an offer based on ETA, or effective tax administration. To understand the formula that the IRS uses to evaluate that offer, check out my video on the OIC formula, and then check out my other video where I discuss the top reasons why your offer was rejected. Now, according to the IRS, they will accept an ETA offer if the IRS determines that although the government could collect the liability in full, even if they have to levy your bank account or garnish your wages, collecting the tax would cause an economic hardship. The IRS might also accept an ETA offer, and this is a major key, where the compelling public policy or equitable considerations warrant granting relief. You see, this is huge because essentially the government is saying that even though you might not qualify for an offer based on the numbers, they might grant one anyway if there is a good public policy reason to do so. What could be a better public policy reason than a global pandemic that has caused billions of dollars in financial losses, in addition to the 350,000 Americans that have lost their lives as of the time of this recording? In the context of the pandemic, an ETA offer is going to be based on what the tax code calls equity and public policy considerations rather than the cut and dry formula that normally applies. Let's take a look at a few examples to see how an ETA offer might work. Mike and Laura owe $60,000 in back taxes. They're on a fixed income and have no monthly discretionary income and no net equity in assets except for $100,000 in home equity. They would not qualify for an offer based on collectability because of the home equity. The reason is because they could technically sell their house and pay their back taxes, but then where would they live? So I think a couple of arguments could be made at this point. Mike and Laura owe $60,000 in back taxes. They're on a fixed income and have no monthly discretionary income and no net equity in assets except for $100,000 in home equity. They wouldn't qualify for a DAC offer because of the equity. This is because they could technically sell their home and pay the taxes, but then where would they live? I think a couple of arguments could be made that point toward a strong public policy reason to keep these people in their homes. Because of the pandemic, the local government and some states currently have a moratorium on foreclosures because of the government's desire to keep people in their own homes in order to slow the spread of COVID-19. Many states currently have stay-at-home orders, also designed to keep people in their own homes and slow the spread. For these reasons, I think you could argue that forcing Mike and Laura to sell their home during the pandemic just to pay the IRS would go against the government's stated policy objectives. Another example, Rob owns a restaurant which has been temporarily closed due to COVID. He owes $50,000 in back taxes, but he has $60,000 in a retirement account, which he could use to pay the debt. The money in the account has been the only source of income for Rob and his 3 dependents. He would not qualify for an offer based on thatas to collectability because he has sufficient equity, money in the bank that is, to pay the debt. However, he might qualify for an offer based on effective tax administration. The key here will be 1, demonstrating the special circumstances caused by COVID-19, and 2, showing that liquidating the assets to pay the outstanding tax liability would render him unable to meet his basic living expenses. Because many of the collection defenses available to taxpayers depend largely in part on the taxpayer's specific financial condition, taxpayers who have experienced significant adverse financial effects from COVID-19 may have a limited window of time to resolve their tax debts more favorably with the IRS than what they would otherwise do after the COVID-19 pandemic subsides. The offer in compromise based on effective tax administration is rarely used. It's not often granted, and honestly, it's probably not a do-it-yourself project. But with the right circumstances, I think it definitely can be an effective tool during this brief window in time caused by COVID-19 to settle your tax debt for less than you actually owe. Speaking of settling your tax debt for less than you actually owe, I want you to know that there are special programs in place to help you get a fresh start. But how do you know if you qualify? You see, no 2 cases are exactly alike. So how do you know exactly how much you can settle for? Well, I've created a free tool to help you get qualified for a fresh start. Just head over to my website, www.levyking.com, or click the link below. Follow the prompts and answer a few simple questions, and we'll help you figure out your eligibility. That website again is www.levyking.com, or you can give us a call at 1-877-LEVY-KING. That's it for this week, guys. Talk to you later. Bye.
1-877